For those of you who have joined, good morning. We're just going to give it a minute or two to let some other attendees jump on. In the meantime, maybe for sound check purposes, if you can just click the raise hand button at the bottom of your screen, if you can hear me, that'd be great. Okay, excellent. Looks like audio is working just fine. Okay, we're going to go ahead and get started. Good morning, everyone, and welcome to the ProNexus Lease Accounting webinar. By way of introduction, my name is Rafael Vidal. I'm one of the founding partners of ProNexus and lead partner for Leases. And with me, I have Dan Hawthorne and Mike Knapp, who are part of our lease advisory and implementation team. Mike, Dan, you there?
Yep, I'm here. Good morning. Hello, good morning.
Excellent, thank you. We have our email addresses on this slide, so feel free to jot those down now in the event you'd like to reach out to us individually after the presentation. And before we begin, we do have a few housekeeping items to address. You will be muted for the duration of this presentation, so if you have any questions, please use the Q&A feature at the bottom of the screen. We'll answer those questions throughout the session, and most likely it'll be towards the end, if you will. And there will be a recorded version of the webinar that will be sent out to all the participants as well. And lastly, we do have a few polling questions throughout the presentation. We ask that you take a few seconds to answer those questions as they come through. For those of you on the call who aren't familiar with ProNexus, ProNexus was founded by two Big Four CPAs, from Pricewaterhouse and Deloitte. The entire leadership team are CPAs, controllers, and CFOs. We operate the firm very much like a CPA firm. However, we only perform non-attest services. 5 core services include consulting, project work, outsourced accounting services, interim and loan staff services. And if you'd like to learn more, feel free to visit our website. On the home page on the upper right-hand corner is a link to our case studies, which really gives you a good idea of how we help clients. In terms of experience with leases, for the last 3 years, ProNexus has been helping companies implement the new lease accounting standard. We've developed a number of significant IP and tools to streamline the process. In addition, we've invested into lease accounting software to help accelerate the implementation as well. And we've worked with clients with as low as 10 to as many as 1,000 leases as well. As you can see, we have an action-packed agenda for you today. Agenda items 1 through 10 will provide you an overview of the new lease accounting standard. Items 11 through 17 will provide you a roadmap on getting started, including keys to success and pitfalls to avoid. Items 18 will provide you software solutions to consider, including a mini demo that we'll have for you today. And finally, we'll wrap up with some recommendations, how we can help, and some Q&A. And before we begin, we're going to give you 15 seconds to answer our first polling question. Excellent, thank you. So what is the new lease standard? The new lease standard is intended to account for all lease obligations on the financial statements. The end goal is to provide more transparency around leasing contracts. Operating leases will now be treated as assets and liabilities. And when are you required to use the new standard? Most 1231 privately held clients will be required to comply in 2022. However, day one, processing lease activity the new way begins on 1/1/22. If you want to get ahead of this, we recommend you start thinking about and planning for 842 implementation, especially if you have third parties like your bank relying on your GAAP financials. There is a lot more work than people think, and best practices is really to have all your chart of accounts properly structured and lease administration processes in play before 1/1/22. So if you haven't started yet, not a big deal, but you will have to retroactively go back to 1/1/22 to account for lease activity a little bit differently. So understanding the new rules, at a high level, the end goal is to provide more transparency around leasing contracts. Operating leases will now be treated as assets and liabilities, and some procurement contracts may contain embedded leases. For example, raw material procurement contracts or warehousing agreements. I'm going to turn it over to Dan quickly to provide further insight into embedded leases.
Thanks, Raphael. Good morning, everyone. ASC 842 actually requires you to examine all contracts to determine whether each contract is or contains a lease. A contract has an embedded lease if there is an identifiable asset and the lessee has control of the asset and receives substantially all the economic benefit. And that's actually the test two for what you've already identified as an operating lease or a finance lease. So for an example for the embedded leases, just to kind of give you an idea of how complicated the standard can get, is that one of our clients had warehousing contracts that did not qualify as operating leases under 840, but did qualify as operating leases under 842. The facts were the warehouse is the identified asset. The lessor did not have the right to service other customers without the lessee's permission. So the lessee had control. The lessee had 90% or more of the warehouse's capacity, therefore received substantially all the economic benefit. This one service contract under 840 now qualifies as an operating lease under 842 and had to record an asset and a liability on the balance sheet. We also have a medical client with agreements to purchase a minimum amount of supplies. And in turn, they receive the related equipment to use those supplies at no cost. For example, this client had a procurement agreement to purchase leg compression sleeves and accessories for hospital inpatients to prevent blood clots in their legs. There was a minimum commitment to purchase these supplies to work the machine, and the machines were available to them at no cost for the life of the contract, and they were to be returned to the provider or the lessor at the end of the term. On the surface, this looked like a procurement contract for the purchase of medical supplies. But now this client needs to take a closer look at these types of agreements and others like them to determine whether the compression machines would have met the definition of an embedded lease and have to recognize an ROU asset and liability, which in this case they did. And they had many more as well.
Thanks, Dan. So as you can imagine, there's now additional visibility provided to leases, which will increase the level of scrutiny from your auditors. So expect to spend more time testing the completeness and accuracy of your lease data. And with leases transitioning to the balance sheet now, CFOs need to consider the impact to your financial performance metrics, such as working capital, Perhaps you have some executive comp or performance plans that are impacted by this as well. And then obviously compliance with your debt covenants and borrowing ability. So many of our clients are concerned about potentially violating those bank covenants under 842. So we highly recommend getting a handle on the potential impact and start having conversations with your bank as early as possible. Additionally, a lot of our clients have had to address how much effort will be required to comply and what the administrative burden may be for accounting and other departments such as IT. If you guys have any questions, I just want to remind you, please use the Q&A feature at the bottom. I'm going to turn it over to Mike now to discuss the differences between 842 and 840. There you go, Mike.
Great, thanks, Raphael. As you probably know, ASC 840 had identified two types of leases, operating and capital leases. Capital leases have been treated as long-term assets and are capitalized to the balance sheet. Operating leases, on the other hand, are recognized as period expenses. These haven't been capitalized to the balance sheet, but balance sheet adjustments are sometimes necessary to recognize the expense on a straight line basis. On the current slide, we look at the new aspects of ASC 842 and how they compare to the old standard. As we've already discussed, the new standard provides a little more clarity on the scope and definition of what qualifies as a lease. But basically, a lease is an identified asset that you control for a specified period of time. Now, US GAAP, IFRS, and GASB have all come out with new standards. While each group's original intent was to better align the three, they really haven't been aligned in all areas and may require separate accounting. Today's presentation will be focused on US GAAP. If you do follow IFRS or GASB or just want additional information, we'd be happy to schedule some time to discuss this with you. Now, under the new standard, accounting for the lessor is relatively unchanged. There are some new classifications, criteria, and modifications that leverage certain guidance in the new RevRec standards, but the new lessor accounting remains similar to the existing standard. Because of this, today's presentation will be focused around the lessee. If you are a lessor, we'd be happy to schedule some time to discuss those requirements with you. Now, under the new standard, the treatment of capital leases, which are now called finance leases, also remains relatively unchanged. The big change in the new standard is with operating leases, which must now be capitalized on the balance sheet. We'll talk about these steps in more detail, but here's a quick overview which covers items 5 and 6 on the current slide. A right of use liability is first recorded and is calculated as the present value of all lease payments. Basically, you're creating a loan amortization schedule. A right of use asset is then calculated to be equal to the initial right of use liability, plus or minus adjustments that may be needed, such as upfront payments or existing ASC 840 liabilities. Then in subsequent months, adjustments will be made to these initial balances. The liability will be adjusted like a normal loan amortization based on cash payments less a calculated interest expense. A straight line expense will be determined based on the total lease payments divided by the number of periods. And the asset amortization is equal to the straight line expense less the current period interest expense. In the coming slides, we'll also discuss some required changes to the balance sheet, income statement, and cash flow presentation, as well as significant changes with the required disclosures. And the new standard introduces a few policy elections and practical expedients that you can choose to elect. In some cases, these can help ease the burden of implementation. In other cases, they become more of a best practices type of election. The following slides will cover items 5 to 9 in more detail, and Dan will start by covering the initial recognition and measurement.
Thanks, Mike. Yeah, as Mike said, this slide talks about the recognition and measurement of leases. For the balance sheet, the recognition and measurement of new operating and finance leases once you have implemented the standard, which we refer to as after day one, for both the ROU asset and liability, will be the present value of the lease payments using the discount rate. Assets will be adjusted for any prepayments, made or incentives received. For existing operating leases before day one of implementation, the ROU asset and liability will be the present value of the remaining lease payments. The asset will then be adjusted by any outstanding 840 balances related to the lease. For example, if you have prepaids or deferred rents or accrued rents remaining at implementation day, you would write those off against the new ROU asset and everything would amortize in one account. For existing capital leases, the ROU liability will increase based on the interest method using the discount rate and will then be reduced by payments made. The ROU asset will generally be amortized over a straight line basis, similar to the 840 amortization schedule. Expenses on the income statement generally will be front loaded for finance leases and straight line for operating leases. And for the balance sheet presentation, the ROU assets can be presented either separately or together with other assets. If presented together with other assets, you need to disclose the line items that includes the ROU assets and their amounts. Finance lease ROU assets must be presented separately from operating lease ROU assets. These assets are subject to the same classification as other non-financial assets. The ROU liability can be presented either separately or together with other liabilities. And again, if presented together with other liabilities, disclose the line items that include these lease liabilities and their amounts. Finance lease liabilities must be presented separately from operating lease liabilities. And these liabilities are subject to current and non-current classification similar to other financial liabilities. For leases dominated in foreign currency, where remeasurement to the lessee's functional currency is required, need to keep in mind that the ROU asset is a non-monetary asset and will be measured at historical cost and is not affected by subsequent changes in the exchange rates. On the other hand, the lease liability is a monetary liability and will be remeasured at the period end exchange rates. Changes in the lease liabilities due to change in the exchange rates will be recognized in profit and loss. Now, Mike will address the income statement and the cash flow presentations.
Thanks, Dan. As you may have noticed, a lot of the new accounting treatment and disclosure requirements have been differentiated between operating and finance leases. Under the new standard, expenses related to finance leases will have two components, interest and amortization. This is consistent with the current capital lease treatment. The income statement presentation will need to be consistent with how the company records similar expenses. Now, company's interest expense will be determined based on the related loan amortization schedule, and this should be included with other interest expense. The right-of-use asset will be amortized on a straight-line basis, and this expense is included with a company's other depreciation and amortization. Because the amortization expense is fixed and interest expense decreases over time, this treatment for finance leases results in more expense in earlier years and less in later years. Now, for operating leases, the lease expense will be presented as a single operating expense in income from continuing operations. As we mentioned previously, the lease expense will be recognized on a straight line basis over the term of the lease. This lease cost will be recorded as a single line item without any differentiation between the interest and amortization components. Now, moving to the statement of cash flows, payments made for finance leases will again be broken out into those two components. The principal portion of the lease liability will be recorded with financing activities, while the interest portion will be recorded with operating activities. For the operating leases, it's just another one-line disclosure. The entire lease payment will be recorded with operating activities. Now, any short-term or variable lease payments will also be disclosed as a single line item use of operating funds. The new standard also requires non-cash disclosures to reflect any right-of-use assets obtained in exchange for the new lease liabilities. And in addition to the non-cash disclosures, there are certain required qualitative and quantitative disclosures. And now I'm going to turn it back to Dan to talk about some of the qualitative requirements.
Thanks, Mike. The qualitative disclosure objective is to enable the financial statement user to assess the amount, timing, and uncertainty of cash flows arising from leases. This disclosure should include information about the nature of the lease portfolio, basis, terms, and conditions on which variable lease payments are determined, extensions, terminations, and purchase options, options that are and are not recognized as part of the ROU asset and lease liabilities, restrictions or covenants imposed by leases, significant assumptions and judgments made, information about leases that have not yet commenced, but that create significant rights and obligations for the lessee, lessee transactions between related parties, and any other significant information you feel important for the financial statement user to have. Now, Mike will talk about the quantitative disclosures.
I think we pushed that to a little bit later in the.
That's right, Dan. So I think, thanks, Dan. In the previous section of the slides, we covered a lot of material, including the comparisons between 840 and 842. We discussed the initial calculations and schedules. We looked at the balance sheet, income statement, and cash flow presentation, as well as the disclosures. So as a reminder, if you have any questions, please use the Q&A feature at the bottom. We'll give you a few seconds here to type in any questions that you might have, and then I'll turn it over to Dan to discuss the policy elections. All right, Dan, do you want to jump in on the policy elections now?
Okay. All right, the new standard allows for policy elections to be made for compliance as of day one. Keep in mind that once these have been made, they are not to be changed. The policies can differ by asset class, real estate versus equipment, for example. We're not going to discuss all of them in detail, but provide a few examples. I'm going to talk about a couple simple ones, and Mike will get into one of the more complicated ones, but you can make an election not to include any leases with terms of 12 months or less in your ROU asset calculations. You can choose not to show 842 comparative periods and only show the current period. So Mike is now going to go through one of the more complicated ones.
Okay, thanks, Dan. ASC 842 has introduced to us the concept of lease and non-lease components. And one of the things you can do is to make an election related to whether you include or exclude any payments related to non-lease components when you're making your ROU calculations. Now, here's an example. With an office lease, you might be paying for four things: the office space, common area maintenance, real estate taxes, and insurance. Under 842, the office space and common area maintenance are considered components because they are either an asset or a service that you're paying for. The office space is considered a lease component since it is the identified asset. And then the common area maintenance is a non-lease component because this is a non-essential service that you're paying for. And what that means is that the office space is not impacted by whether or not this service is performed. For example, if the landlord doesn't cut the grass or clean the common areas, the tenant can still use the office space. The taxes and insurance, on the other hand, are not considered components, since these are neither a good nor a service. They are the lessor's cost obligations that they're passing on to you as the tenant. And under 842, these additional costs must be allocated between the lease and non-lease components. And then after this allocation, it's just the costs related to the lease component that are used to determine the right of use asset, and the non-lease components are ignored for this purpose. But the identification and allocation of non-lease costs is often difficult and time-consuming, especially for lessees who have hundreds of these type of leases. So 842 allows you to elect a practical expedient to always combine any lease and non-lease components for your right of use calculations, and then forego any additional calculations or allocations that might be necessary. This election will ultimately increase your right of use asset and liability balances, but it can greatly simplify the process. I'll now turn it back to Raphael, and he can go over our next steps.
Okay, thanks, Mike. Next topic is going to be the roadmap to getting started. On this slide, there are 6 key roadmaps to getting started. First, you need to understand the new rules and what the risks are. Secondly, you'll need to perform an assessment and understand the implementation challenges and risks. Next, you need to staff the project team, which includes identifying a sponsor, a project manager, and assigning a cross-functional team as well. You'll need to evaluate the maturity of your current lease program. For example, what systems, processes, and controls are in place. Then you need to define the project scope and strategy. For example, are you just looking to comply, or do you want to implement a best-in-class? And lastly, you'll need to define the budget and timeframes as well. And after completing those 6 steps, you should be in a good position to get started with the implementation. These are the 5 keys to success for the lease accounting project. The first is to build a cross-functional project team. Other than accounting, you're going to want input from other teams, such as your legal department, procurement, IT, real estate, and tax, to mention a few. The second key is to pinpoint the issues with the technical accounting. Embedded leases and equipment leases are consistently reported to be more challenging. And then the third key is collecting the data, which will be the hardest part, and we'll cover that piece in a later slide. Next is choosing your software package carefully. We don't recommend using Excel, especially if you have at least 10 leases or more. It's very cumbersome and prone to errors. We'll discuss software further on another slide as well. And lastly, you'll need to set up a model for day 2 compliance and beyond. Performing the accounting on an ongoing basis will require processes that keep the leasing data accurate, complete, and up to date. And you'll need to establish policies and controls for the lease management. You could also partner with a firm like ours and outsource the maintenance of the software and or the recurring compliance as well, if you don't have the internal expertise or bandwidth to do it yourselves. Some of the most common mistakes include ignoring the non-real estate leases and looking at your internal controls and post-implementation as well. The data for the non-real estate leases will be much harder to collect. Most companies don't have a centralized group nor an enterprise application to track them. Post-implementation success requires the development of a repeatable process to consistently maintain accurate and complete lease records to comply on day 2 and beyond. It'll also require automating some of your processes for tracking changes to leases as well. And lastly, you'll need to have some systems, processes, and controls in place that will stand up to an audit. Before we walk through the workflow plan, we want to cover what companies typically lease and where the leases can be found within an organization. So in addition to your real estate leases, here you'll find some of your typical non-real estate leases. For example, your IT and data center equipment, vehicles, and manufacturing equipment. And as mentioned previously, some of these non-real estate leases could be embedded in procurement contracts as well. This slide here illustrates 11 places to look for leases, which includes anywhere from accounts payable to IT to your legal department. And in some cases, our clients couldn't find some leases and we had to go to the lessors. And because there are so many departments involved, it's important to build a cross-functional team for this project, which is one of the keys to success that we mentioned earlier. And before we begin the workflow plan, we're going to give you 15 seconds to answer our second polling question. Okay, great. Thank you, everyone. Okay, so this represents a typical workflow plan that we use when implementing the new standard, and this aligns with what to expect from your audit firm as well. All this work we actually cover in 3 key phases. The first 2 phases are planning, scoping, and the assessment phases. And all that work, if we were to do it for our clients, it usually takes up to 100 hours of time. The third phase is the execution phase, which is where we actually review the contracts and extract the data from those contracts and load the information into the software. That's where the bulk of the work lies. But if you get through phase 1 and phase 2 early, that at least gives you visibility to what's ahead and what the scope of this overall project is going to be for you. So one of the first tasks will be to perform an assessment and obtain an understanding of the current state lease processes and the relevant procedures, data, and systems involved. The assessment will allow you to determine the size and scope of the overall effort. For lease accounting projects, the complexity will not necessarily correlate with the size of the client's company or their annual revenues. Instead, it's really a function of the complexity of the client's lease portfolio and the maturity or immaturity of the related processes. We do have surveys and questionnaires that we use as a starting point. We also speak with the lease stakeholders, and during this process, there might be opportunities to identify savings by not only solving the lease accounting problem, but by enabling better lease administration as well. The next task is to perform an enterprise-wide lease census. Our goal here is to build a master list of all leases, including embedded leases. We just reviewed some of the assets companies typically lease and where to look for them. We have a checklist that we go through to ensure completeness. We document the testing performed so that this can be provided to our clients' auditors. And as we perform our review, there are several places to look and questions to ask to build that census. Some of the questions we ask to build that census occurs during the assessment phase that we just covered. And key questions include, who negotiates leases, who manages the leased assets, and who reports on the leases, just to name a few. Another task here is to define the project strategy. On one hand, your leasing program may already be mature and you decide that the strategy is just to comply. On the other hand, you may want to do more than just comply. Perhaps there's some significant savings opportunities and you decide that the strategy is to transform. As you're performing your work, the end goal is to design, number 4 here, the future state, which applies to day 2 and beyond compliance. Here you want to design business processes and systems for the future. The 5th task is to determine how long the project will take, the resources required, and estimating the budget as well. Now, number 6 and 7 on this slide, collecting the lease accounting data coupled with the contract review. This is where that phase 3 really comes into place, the execution phase, and it's the most time-consuming aspect of the project. We have a list of 100 data elements that we recommend clients extract from their leases. We have, with some of our other clients that are implementing a more robust program, we've seen as many as 180 data elements collected. I'm just going to skip ahead real quick to slide 20 here. And you can sort of see from starting from the lease census, this schedule summarizes the different activities required to collecting your lease accounting data. And the information is split between two phases, the planning and analysis phase and the data aggregation and upload phase. I'm going to go back to the workflow plan to discuss the contract review process, number 7 here. So in terms of labor effort, we keep talking about this is where all the labor really is. It takes on average 2 to 4 hours per lease on the low end and 6 to 8 hours on the high end to review contracts. Now, I'll also tell you that if you have people that don't have much experience reviewing contracts and understanding the legal language, it could take those folks up to twice the amount of time than experienced professionals. For example, Mike here, who's a senior manager on our team, can review contracts on average 1.5 times faster than some of our seniors can. We already covered number 8 of the policy elections in a previous slide, but I would add that in some cases, clients will ask us to prepare a pro forma analysis to support some of their policy election decisions. And then number 9, for selecting a software vendor, let's go to slide 21 here. As mentioned previously, our firm highly recommends considering lease software solutions, especially if you have at least 10 leases. Using Excel to manage the ongoing compliance will be difficult and will increase your risk. This slide illustrates some of the essential and innovative features the software offers. There's many solutions available in the market, but the software we're about to demonstrate for you is the only lease accounting software made by former CPA firm auditors. And this software was named Best Lease Accounting Software by Digital.com, and it was also rated #1 easiest and most accurate lease accounting software on the market. The software provides you unlimited users, and you're only charged based on number of leases. The software is a cloud-based centralized repository for all your leases and supporting documentation. It has a lease classification, lease term, and embedded lease wizard within the software that can guide your staff with the proper accounting for leases. And the software is designed really to comply with the new standard by providing you all the reporting required, including the amortization schedules, the journal entries, and the automated footnote disclosures, which Dan's going to show you in a few minutes. And lastly, it has audit trail features, and you're able to provide your auditors access to this software so they can perform all their testing right in the software itself. The lease accounting software is cost effective. It can be purchased through our firm if you choose. And for example, if you have 10 leases, it would cost you no more than $1,500 per year for the subscription license. And for that price, the solution is highly recommended over using Excel spreadsheets. So with that, I'm going to turn it over to Dan to give us a little bit of a mini demo on this software. Dan, you there? I'll stop sharing my screen and have you share yours.
Yeah. Yep.
Okay, great.
Good. Okay. Can you see my screen?
Yes, sir.
Okay. So you can see up here that we've already signed in to our firm, our company that would be set up, which is ProNexus. We have these 3 major tabs up here: administration, add lease, and my leases. So we won't go through the audit trail, but it's really just, Raphael talked about it. You select that button, it'll run a report. You can copy that report into Excel and it'll tell you when, where, and how, and what was changed and who changed it at what time. So that's one of the great features. So we're going to start with the administration tab, and we're going to look at the users. And throughout the views of these screens, you're going to see there's a lot of these green buttons here. We're not going to open up all of them, but they're very easy to use. So if I want to add any user, all I do is type in their email address, first name, last name, and I get to select their role. So you have a read-only role, you have a user role that can go in and add lease data information. And then you also have an administrator, which would have access to be setting up companies and GL accounts and that kind of background type setup for the system. Okay, so, and if you want to, you can also edit these and disable them if you want. If you have somebody you need to get out of there, you can just easily disable them. All right, then we're going to go to policies. So the account policies, as Raphael talked about, you can enable firm access to my account. So you can see that's ghosted out because we have it clicked on. So you can click that on or off and give people access through that, or the previous screen where you can just enable them and disable them. Raphael also mentioned the lease term guidance. So what this tool is when you go to add your payment stream dates for your lease, you can record the original term and it'll give you an option to go in and ask you a question about, are you going to terminate? Yes or no. And if it's yes, you put in that date you're going to terminate, and it will record the original end date and the new termination end date. Or you can get this, it will take you to the renewal option. If like, okay, here's the end of the first 10 years, and I know I'm going to take that 5-year renewal, and I can fill all that information in and it will track that. Also, the classification wizard, which will take you through basically the 5 bright lines. And we'll kind of look at that a little bit when we walk through my leases, but that will generate the questions. Does it have a bargain purchase option? Is it over 75% of the economic value? So it'll walk through that and record that. Great feature to have once you start adding new leases after day 1 to prove to your auditors that you've actually done the testing. Required review and approval of new leases. This is an option you can turn on where you can have the user add all the information, and it will be in the lease once all the information is complete, and it will be active. Or once you get that filled out, you can have the renewal turned on and you can send it to anybody on your list or add somebody to that list, and they would get an email to go in and review this lease and select approval, and then the lease would be active. Also, a really nice feature it has is the lease accounting policies. So you can see the list here of these different policies. So we'll open up one of these. And it just kind of gives your basic, it's already documented all your accounting policies. Okay. All right, so here's a list of the policies, and you just kind of go through, and it already has all the documentation. It quotes the standard. It gives you whether you're going to elect it or not elect it. You can put in your comments, and it has, you know, a stated advantage or disadvantage, and it goes through all of them. Some of them are combined, like Mike was talking about, the relief transition policies that you can select as well. And once you fill that out and get it approved, you can upload it, and it will always be in your software. The next one's the reporting entity. So again, here's all the different reporting entities we have in this demo. As you can see, they vary. You can add as many as you want. It's got different accounting standards. And again, you just select this add green button. You go in here and you put your name. So if you have, 10 different entities you want the leases to be held in, you can put those names in there, select that it's ASC 842, or if it's IFRS, you select your initial application date, which in our examples, we've been talking about 1/1/22. In this demo, it's 1/1/19. Local currency and functional currency, if they apply. So if you have other foreign entities with different currencies, you can enter that information here. the customization tab. So here, again, you'll see these green buttons here where it's just easy, just add an asset type. So if we want to add something different, freestanding office building or whatever the case may be, you can get as much detail as you want. If you decide you don't want that, you can just X those out and they would be gone. You can set up your cost centers. You can set up other custom fields. We have people use the custom fields for other information they want. So if you kind of want to have, as you can see, we got the lease owner, we got their email set up in here. You can put like, they have to be notified, send them an email 120 days before the end of the lease to remind them that that they need to start looking at this lease, whether it's going to be renewed or terminated. And then here's where you can add your lessors. So lessors by name. We also have GL accounts. Now, throughout these screens, you'll see these select reporting entity, and there's these question marks. So if you click on the question mark, it will take you to the knowledge base that the software provides you for, which will have guidance for that specific spot. It also holds the SOC reports, has videos to help you actually to be able to see different locations within the software and give you guidance on how to fill that out. And we'll walk you through those. And so when I select an entity, you can see that these are all the entities that I have. So I'm going to select ProNexus, and these are out of the box standard accounts that are required by the standard. So as you can see, there's a list of them here for operating, finance leases, and you got the variable expenses. You got the revisions. So if you have a revision, you may have a gain or loss when you renew that lease. And then you have your existing balances to for under 840, which will be eliminated. The accrued and prepaid rent. And again, you can change these accounts and add your own GL number or your own description by just hitting the edit key, and that will allow you to type whatever you want in these areas. And then you just save it and you're all set to go. And there's a currency tab. So if you do have entities with a foreign currency, you can load all those rates here. You got average rate and month end rates. So now we're going to go to my leases. And here we'll list all your leases. So we'll start from the top here. We're going to select a view so you can save a custom view. We have a few in here. So we're going to do the Pittsford demo. And here we have 3 leases. And you can see here, we have one set up with the review tab. We have one that's set up without the review tab. And then we have a remeasurement test where you can go in and actually go in and say, 3 months left, I'm going to take that 5-year renewal option, or maybe after 2 years, I decide to terminate it. And this will recalculate your ROU asset and liability and all the other journal entry pieces that you need. So again, this is very convenient because it does it automatically. And if you try to do that kind of stuff on a spreadsheet, it becomes very cumbersome. You can also look up leases through these different fields that you'll kind of see. So you can look at end date. You can say, I just want to look at all my building leases. You can go through the different reporting entities, etc., your locations. And up here where the add lease is, we're not going to look at that, but basically we're going to look at a lease that's already filled out. So when you go to put in a lease, originally you would do add lease, but it looks the same as what we're going to look at. Here's the checkbox that you would check if you were going to run a report. Here's if you want to edit the information that you have in or enter the information you have in. This will just give you a detailed PDF report with all the fields and the information. If you want to delete that lease, you have the option to do that. or you may want to clone that lease because maybe you kind of have the same lease, but you have the same information and maybe it's just in a different company. So an example is we have leased 10 X-ray machines, and they're all different leases, but it's the exact same information at 10 different locations in our health system company. So it's easier. You just click that and you change the name of the company within that lease. So we're going to open up the edit piece here. So as you can see, we're here. We got the audit trail again. Here's where we'd add a revision if we wanted to change the dates on that. And then here's the reporting entity where we have the drop-down list of all our entities that we have in there. And again, when we looked at that customization tab or field in the administrative tab, you can also skip that and come right to adding a lease and add all that information in there. So here we have the basic information, local currency, reporting entity, and again, the question marks to be able to go back to that knowledge base and get some assistance. We got a description of the company. We got a lease name. The amount of text that these take is plenty enough. I think we've put 50 plus characters in there and never had a problem. So we have manufacturing for your non-real estate leases. We got our asset type. And again, we got the drop down from everything we had, or we can just add a new one here. All right. We got the building size. We got the location. And here we come down to the dates. So we got the start and the end date. And you can see these are grayed out because we have used the wizard in this example. So here's the lease term wizard. So if I open that up, you can see we got a start end date. So that's the original one. And if I click next, it would take you, are you early termination? Are you reasonably certain to bypass that early termination? And we said, yes, we're going to bypass it. And then you have the renewal as well, that we're not going to exercise the renewal, and that will document all that information if you make that change. If you have that turned off, you can just go in here. You can go in here and put the start and end date, type them in, and you're done with that. Here's a comment field, which we happen to put the renewal comments in there. Here's the custom fields. And again, you can just add your custom field here. And then you save your changes. And then you got your lease payments where it's going to ask you for your discount rate, any incentives or indirect costs, which because this was an existing lease, these are grayed out because it does not affect your ROU asset. If the lease existed before day one, which these will be unghosted if it is after your day one. And then you got your payment frequency. We said monthly, and here's our different payment streams. And it's easy enough just to delete these if you want, or you can add another payment stream. Here's where we would eliminate the existing balances. We said we had a prepaid rent of $5,000. So that would be part of the journal entry where you would credit your prepaid rent and you would debit your ROU asset. And then that would $5,000 would amortize over the life of the lease under the ROU asset. Here's where we put the lease classification. Again, you can see that it's ghosted out because we did do the classification wizard. Again, if you don't have that turned on, you'll be able to just be able to pick from the drop down, whether it's an operating lease or a finance lease. So if we open that up, you can see that, it asks you the 5 bright line questions to determine whether it's an operating lease or qualifies for a finance lease. And then it will calculate your over 75% of your economic life, or you can calculate whether it's greater than 90% of the fair value.
Hey, Dan, I just want to do a quick time check. We got about 6 minutes left. So
Okay.
I want to make sure we have some time for at least a question or two.
Okay.
Not sure if you want to do jump right to the reports.
Yeah. All right. So we got, I'll be there in a second. We got the GL accounts here. There's allocations available. Also, you have where you can put your variable expenses And this is where you can attach all your lease documentation. So I'm going to go back to my leases. We'll run some quick reports. Okay. And basically you can run a journal entry report, an amortization schedule, a footnote, or you can run an all lease data report. So since we're pressed for time right now, we're just going to put our date in, say January 19, and we're going to go December for the 1 year. And let's run an amortization schedule because everything else is kind of, the journal entries are pushed off this amortization schedule. All right, looks like I'm having technical difficulty. Oh, there it goes. Okay. All right, so here's your amortization schedule. So this is, you can see where we have entries and then we have balances. So this is the ROU asset at the end of the month. This is what it started out as. And you have all the other pertinent information that you need to record your journal entry or just to see what your amortization schedule is going to look like. And here's that $5,000. The other part is that this is the criteria. And here's all the lease information data that from the leases that we just selected and ran this report. You can also run that report for all the individual leases without any of the calculation.
All right.
Okay.
Thanks, Dan.
Yep. And it's got a full footnote too. So with all your quantitative disclosures as well. All right, we'll turn it back over to you.
All right. All right. We're gonna give everyone just 15 seconds real quick to answer our final polling question. Excellent, thank you. Okay, so we made some recommendations throughout this presentation. However, this slide really summarizes them all in one location. Our first recommendation is to make good policy elections. Next is to get an early start on understanding the impact on banking relationships and checking with your banks. The third is allowing sufficient time to implement. The next is to choose a software solution and place a spreadsheets. Next is to partner with a firm to provide advice, supplement your team, or even outsource this. And lastly, take action as soon as possible. It's important to assess the size and complexity of your lease portfolio, the strength and current centralization of your process for leases, and the scope of your implementation process. And with any accounting standard change, it's important to get an early handle on it, get the experts involved when needed to provide the best and most prudent advice. The new lease standard is subjective and open to interpretation, so having the supporting documentation for the policy elections and the confidence in the calculations will make for a smoother implementation. If you do feel like you're behind or you want an independent, objective look to confirm you're on track, or you have some gaps you'd like to address, Pronexus can help you. We've been working on this for over 3 years now, starting with the publicly traded companies, and we've invested in software. We've developed the IP and tools that can help you accelerate your implementation. Here's a list of them on this slide of the tools that we have developed. A lot of our clients have suggested that their CPA firm or auditors have offered help with the 842 implementation. And in some cases, this may require additional language in the engagement letter that skirts around the independent issues and transfers more risks to you. We caution that audit independence prohibits your auditors from auditing the work they perform and may unnecessarily increase your risk. And apart from the independence issues, oftentimes the resources you may get from a CPA firm are more costly, and many of them may only have public accounting and may not have real industry or 842 experience. If you're looking to partner with a firm, Pronexus can help you in a variety of ways, anything from a full scope implementation to limited services. For example, limited services may be an option for you if you feel that your 842 implementation is immaterial, you plan to perform the work yourselves, or you require additional bandwidth and expertise to get it done. We can help you understand the rules, assess your current state, put together an implementation plan to execute on, assist you with the software, manage the process, or simply provide our expertise as needed. So with that, I think however you structure the resources and tools and expertise to implement the new standard can vary. We can also sit down with you and discuss your requirements and options available to your organization. So I think with that, I think we can go to questions. We're at 12:01. Maybe, Dan, we can address one question before we wrap up.
Yeah, Ralph, let's see, based on the delay in the implementation accounting standard, what can you do now to speed up the process? Because I know a lot of people, if I'm reading this right, that a lot of people are behind because they got that extra time, but they probably haven't started at it. So what's the fastest way they could start?
Well, I would say for those companies that have started implementing, we would recommend continuing the implementation efforts. For those that have not adopted, at a minimum, we would recommend to get started with one of two options or a combination thereof. The first option is to complete the planning, scoping, and assessment phases that we talked about earlier. There's not a lot of work there, and it'll really provide you visibility to what's ahead while identifying the high risks and planning accordingly to meet the compliance deadlines. Pronexus could actually get this work done in less than 100 hours. The second option is to purchase lease accounting software, abstract the data elements from existing leases, and upload the data into the software. This will allow companies to maintain the lease data in a central repository, estimate what your day one ROU calculations may look like, and allow for a quick and seamless implementation when you're ready to go full speed ahead on the compliance. The lease accounting software, as mentioned before, is cost effective and it can be purchased through our firm. So I think that covers it for today. I appreciate everyone joining us on the call. Again, if you have any questions, feel free to reach out to us. We do have some future webinars starting back up in September and October. We usually take the summers off on the webinars, but we do have pre-recorded demos and webinars that are available if you'd like them, or we can also schedule individual meetings with you to go through whatever questions you may have. So thank you again for joining us today. Mike, Dan, appreciate your time. Caitlin, thanks for coordinating everything, and we hope you found this information valuable. Please enjoy the rest of your week, and we'll talk to you soon.